everyone, and welcome to our lesson on reading and interpreting price action. Interpreting price action is one of the most critical skill sets that you can learn as a day trader, and this lesson lays the framework and the foundation for a lot of the other topics that we're going to cover later in this course. So, very important lesson, and there's a lot to cover. Let's get into it. Alright, so in today's lesson, we'll start off very basic with just how you read candlesticks. We'll then talk about why we use candlestick charts over traditional standard line charts. Then we'll get into important single candle types and what I call the 4 C's of price action. Finally, we'll wrap it up by talking about multi-timeframe analysis and an introduction to support and resistance. So starting off super basic, we have how you read candlesticks. Candlesticks are made up of an open and a close that represent the body of the candle, and a high and a low, which represent the wicks of the candle. Wicks are also often called shadows. So if you look at this green candle here, which would be an up candle, you have the opening price here. At some point it touched this low. It ended up closing right around here, but before it closed, it reached a high that's represented by this point here. Candles can represent any unit of time. You could have 1 minute or even 5-second candles. And you can go all the way out to, again, 1 year or any time frame that you want to represent. Candlesticks are important because they represent the auction that took place during that time frame. So they give us a lot of information that you can't get in line charts. And that brings us to why we use candlestick charts over traditional line charts. So I have a perfect example here to highlight that concept. If you look at the left-hand side, we have a standard line chart off of Yahoo Finance of Apple. And on the right-hand side, we have a candlestick chart of the same time frame, again, of Apple. So here on the left-hand side, you can see that price sold off, flattened out, and then reversed. And there was really no indication, that this reversal in price was going to take place. However, if you had been looking at a candlestick chart of Apple, you could have seen that on multiple days, price actually sold off below that 160 level, and then was bought back up. So you're able to tell that buyers had thoroughly stepped in and would not allow Apple to close below 160. That's significantly more information and significantly better information than just knowing that, okay, price went down here, it flattened out, then it reversed. So hopefully that example highlights how candlestick charts are significantly more valuable to us as traders than traditional line charts. So now that we understand why we're using candlestick charts in the first place, I want to go over a couple important single candle types that you'll want to focus on as a trader. No single candle can be used to determine future price movement. All right, I'm not trying to get across the point that, if you see a doji, then the next candle is definitely up or definitely down. However, certain candles are inherently bullish, bearish, or neutral. So we have a slide for each of these candle types. But the 3 main ones that I want you to focus on are bear or bull candles, doji candles, and hammer candles. The first candle type that we'll talk about are bear bull candles. These are candles that close very near their high for green or up candles, or very near their low for down or red candles. Personally, I actually color my chart red for down candles and then white for up candles, but regardless of the color, you can see that this is a very strong move here on this 15-minute chart of NEO. So you've got the open of this candle down here, and then it actually closes all the way up near its high. So these candles, and there's a bunch of examples here on these 2 charts, once again, are very strong signals that market has decided that value is either higher or lower than the opening price of the candle. We can't determine what we're going to do next, but at least for that time frame, it was clear that the market wanted to push in a single forward direction. The second candle type that we want to cover are doji candles. Now, I'll first off just start by saying that technically, a doji is defined as a candle that opens and closes at exactly the same price. So if you look at these 3 candles, technically only this one would be a true doji, but in practice, both of these and all 3 of these would be referenced as dojis. The key point to take away with the doji candle is that it represents indecision. The market has failed to move either higher or lower during whatever time frame you're looking at. Therefore, you will frequently see this candle preceding a large directional move. So you can see that over here. This is a 5-minute chart of SoFi. You have a doji candle followed by a strong move up. Then you have a series of doji candles over here followed by a very large move down. So again, the key takeaway is that dojis represent indecision. Alright, so moving on to our third candle type, we now have the hammer candle. When a hammer candle forms, price has initially moved in one direction, only to be bought or sold back relatively close to the opening price of the candle. So you can see that up here. Here's some hammer candles, and then here's some what would be called inverted hammer candles. This candle gives us a signal that the market has changed its mind on what otherwise would have been a strong bullish or bearish directional move. You will very, very frequently see this candle at the top or the bottom of a reversal in trend. So once again, I've got a chart of SoFi on a 5-minute. You can see we've got an inverted hammer candle right here, which then precedes a very large sell-off. And then at the bottom of the sell-off, we actually have 1, 2, 3 different hammer candles, and then we get a reversal and a push-up in price. So the key takeaway with the hammer is that the market has potentially changed its mind. Before we move into multi-candle patterns and the 4 C's of price action, I wanted to drop a quick note on 2 to 3 candle patterns. And I put patterns in air quotes. Many traditional texts and many of the people that teach this on YouTube and other places will list dozens of different patterns consisting of many different names. You got tweezers, harami candles, bullish bearish sandwiches, etc. I have purposely chosen not to cover these in this course because in my opinion they put too much focus on the candles themselves and they distract you from interpreting the auction process, which is the whole point. And here's an example of what I mean. Many sources would show this 15-minute chart of AMD, and they would highlight these 2 candles here, and they would call it a tweezer pattern. But what I want you to focus on is that for 2 15-minute periods, sellers attempted to push the price below this level. And both times it was bought back up and essentially failed to break down. So that key takeaway piece of information is what's important, not the fact that this is called a tweezer pattern, right? The key takeaway is that sellers failed 2 times in a row and buyers stepped in and supported price. I also wanted to just have a quick aside on volume. By now, you might have noticed that all of my charts at the bottom have these bars. These bars represent the volume of shares that have been traded during these time frames, and you might be wondering why I'm not referencing them. Volume is critically important to the trading process and to my system, and we're actually going to have an entire lesson on it next. So for now, just focus on learning the basics of price action, and we'll get to volume later. With those notes out of the way, we can now get into interpreting multi-candle patterns. When you're interpreting candlestick patterns made up of multiple candles, it is important to focus on the fact that you're trying to figure out what the market sentiment is. What is that candlestick pattern telling you about the psychology and the emotion of the participants involved in the market? You don't want to focus as much on the specific pattern. Who cares about the pattern name, right? What you want to know is what is going to happen next. As such, I've chosen to distill the hundreds or thousands of different pattern names that you might see out there in other, books or other materials into what I call the 4 C's of price action. At any point, the market is likely doing one of these 4 things, and identifying the phase that you are in can help predict what may come next. So the 4 C's of price action are continuation, which is also commonly referred to as trending price action, consolidation, constriction, and capitulation. We'll get into each one of those on their own slide next. The first C in our 4 C's of price action is continuation. This is also often referred to as trending price action. Trending price action is clear upward or downward movement with higher highs and lower lows. If you're in an uptrend, or if you're in a downtrend, you'll have lower lows and lower highs. A trend will normally respect a moving average, which is the orange line that you can see on the chart here in both of these examples. And we'll spend more talking about moving averages in lesson 1.5. In a trend, the market is buying pullbacks, and it's showing clear conviction that true value is higher, or in a downtrend, lower. Trends can be brought to an end by any of the phases that we'll talk about next: consolidation, capitulation, or constriction. So I've shown two simple examples of trends over here to the right. You've got a 60-minute chart of BABA, so this is a much longer multi-day trend. And then on Snap here, we've got a 5-minute trend, and you can see again that it's setting lower lows here, here, and here, and each time it's pushing, it's making another new high. So that is just a simple example of trending price action. The next C of our 4 C's is consolidation. These are also often referred to as ranges or channels, and consolidation typically follows a very strong move. And it's basically just defined as clear sideways price action, or it's also referred to as chop, in a clearly defined range. So you can see here we have a 1-day example on Ford. So Ford obviously traded up and down within kind of this like $18.75 to $21 range. And then we can also see an example on a 5-minute chart of Carnival Cruise Lines where price, again, clearly remained within this obvious channel. These ranges form for a couple different reasons. And differentiating between these reasons is something that we'll get into in the next lesson. But for now, just basically focus on the fact that they result from either broader market indecision, so they'll happen maybe prior to an earnings call or a big news announcement, or they happen because big players are either accumulating or distributing shares before igniting a new trend in either the same direction or the opposite direction. Okay, so moving on from consolidation, we'll now talk about constriction. Constriction patterns are identified by a tightening price range. There are 2 patterns that I want you to memorize for this particular C in the 4 C's of price action, and those are triangles and wedges. Triangles typically have either a flat bottom or a flat top, and wedges have 2 slanting sides, as you can see in these 2 examples. Constriction, as a phase of the market, can be thought of as the market overall building pressure or loading a spring. In the case of Ford here, you can see that buyers are trying to break through this upper resistance point. Each time that they try to break through it, it fails. But each time that it fails, buyers step in earlier and earlier and do not allow price to drop as far. Ultimately, what will very commonly happen with these patterns is that price will break in one direction or the other, and the move will be very dramatic. So you can see that on Ford here on a 1-minute chart. You can see the same thing on a weekly chart of American Airlines, where you have this kind of slightly descending wedge pattern, and you actually get a fake breakup to the upside here before it breaks down and fails for several weeks in a row. So identifying which side that it's going to break to is actually more of a topic for future lessons in this course. But for now, just identify constriction as a tightening range and building pressure in the market. And with that, we reach the 4th C in our 4 C's of price action. For capitulation, I've broken it out into 2 primary patterns that I want you to focus on: double tops or double bottoms, and then the head and shoulders pattern, or an inverse head and shoulders pattern. With double tops and bottoms, these represent one of the most common reversal signs in the market. You can see them here on a 1-day chart of Netflix and on a 1-minute chart of Carnival Cruise Lines. You get a very clear touch, retouch of the same level, and then a break in the opposite direction. Again, same thing here on Carnival Cruise Lines. With these patterns, I don't want you to just think about the fact that, oh, okay, I've made the double top, I've made my second top, I'm failing, therefore price is going to reject and move in the opposite direction. What I want you to think about is the psychology and the emotion of the participants that are involved. With these patterns, participants have driven price down or up to a level, they have retested that level, and they have absorbed enough buying or selling that the trend can now change directions. So how significant the change in direction will be is going to depend on many factors, most of which we'll cover either in the next lesson or in future lessons of this course. But it's going to be things like how much volume came in, what was the length of the trend prior to the double top or double bottom, how strong is the support or resistance line you're running into. There's a lot of different factors. But for now, that's our first capitulation pattern, the double top and double bottom. The second capitulation pattern that we'll talk about is the head and shoulders pattern. These can be a little bit more difficult to pick out, and they tend to form more frequently on lower time frames. So I have a 1-day example here and a 15-minute example, but just note that seeing these very clearly on a daily chart or anything kind of above, say, like a 15 or 30-minute chart is a little bit more rare. But with this pattern, the important price action takeaway is that the market has hit a level of resistance. So you can see that here on DKNG. It has then broken through that resistance, tested a new level, and failed. Once failing past the original point of resistance, you get a weak touch to the second test of this first shoulder, and then the failure after that will tend to be fairly dramatic. So once again, remember the market psychology behind moves like this. With this DKNG example, you have a bunch of people that were buying up here at the top, thinking that we were going to break, right? We were actually forming an ascending triangle right here, which we talked about in Constriction earlier. You then break through, so you get a bunch of people that are taking profit at this first level. You get a bunch of people that are stepping in and buying at the top and having FOMO. And then with this failure, what has happened, and again, think about this from the psychology of the people involved, what has happened is that you've got a bunch of people that were trapped up here and are now negative, and then you have got a bunch of people that were long from here that at this second retest this level, this kind of area right here, they are now break even. So what you get is a bunch of people saying, okay, forget it, I'm just going to cut my loss, it's not going to go back up. And you get a bunch of people saying, all right, I got a little bit of a partial up here, and now I'm back at break even, I should just get out. And so the combination of all of those participants thinking roughly the same thing but for different reasons results in you getting a pretty dramatic sell-off. So I've shown you another example here on AMD. This is an inverse head and shoulders pattern, but the ultimate takeaway with this is that you're breaking through a price level, failing past it, and then retesting it. And that leads to capitulation and a reversal of trend. All right, so those are our 4 C's of price action. I hope that that was fairly clear to you, and I want you to memorize those and practice them as much as you can. Now, though, I want to introduce real quick the concept of multi-timeframe analysis. When you're evaluating a pattern, any of the patterns that we just talked about, it's important to consider it within the context of the larger time frames. Generally speaking, and again, this is just kind of a rough rule of thumb, the higher the time frame that a pattern is taking place on, the more significant the pattern, because that means you'll have more and more people involved in that decision. So most of the time, you want to avoid taking trades that directly conflict with a higher level trend or pattern. Unless you're treating it as a short-term scalp, you're better off not fighting kind of this larger overall move. And I have an absolute perfect example of this on Carnival Cruise Lines here. So if you looked at a pre-market chart here of Carnival Cruise Lines, you see it's just kind of consolidating sideways, and then right at 9:30, right at the market open, you get a huge move up on this 5-minute candle. Now, if you were not paying attention to the higher time frame at all, you probably think at this point that Carnival Cruise Lines is a long for the day, and maybe you try to play it for an opening range break or some kind of other momentum type play. However, what you wouldn't have seen is that on a daily chart, Carnival Cruise Lines was coming up into the top end of a very clear consolidation range. And you can see now that Carnival Cruise Line went up, touched that level literally to the penny, essentially, and then failed the entire rest of the day. And so if you had tried to go long on the break of this first 5 minutes, you would have gotten trapped and essentially lost, again, you would have stopped out for sure, but you would have lost for the entire rest of the day because you were trying to trade against a pretty clear downtrend in price on the daily level. So that's an example of multi-timeframe analysis. This is a concept that's going to come up throughout the course, so just wanted to introduce it very quickly here. The last topic that I want to cover today is an introduction to the idea of support and resistance. Support and resistance is one of the more important concepts in day trading because many trading setups or many strategies involve either the acceptance or the rejection of these levels, my system included. Support and resistance loosely can be defined as a price level that has been tested multiple times and has become an area of contention between buyers and sellers. I want to stress that support and resistance should be easily identifiable by anyone looking at the chart. If you're the only one drawing a line in a specific price location, then that line is useless because other people aren't paying attention to it. So look at this American Airlines chart over here. I've drawn some dashed orange lines that are clear examples of support and resistance. You can see here, this level was resistance that was eventually broken through. This level failed and then became resistance later on as it was retested. And then you can see this original level was resistance, resistance, resistance. And these support levels, again, were retested multiple times throughout this kind of multi-month time frame on American Airlines. So let's get into a couple of specific concepts that I want you to take away related to this idea. All right, so there are 4 concepts that I want you to memorize and put into practice with support and resistance. The first, which we've kind of already talked about and showed examples of on the previous slide, is that these levels work because of market psychology. And the 2 main examples of that I want to show you, or the 2 main reasons, is that first, past participants have purchased the stock at this level, okay? So when that level is then retested later on, you get these larger participants on these kind of higher time frame levels that still consider that particular price point to be fair value. And so they will actually step in to purchase more of the stock. And other people will also do that, thus leading to the level becoming support. The same thing in reverse for resistance. The second psychology point that I want you to think about is that these levels can be a self-fulfilling prophecy because all market participants can draw them, right? As we showed on the other slide, anybody could have drawn those levels. And so buyers or sellers in the example of resistance will often step in because they see that price has held that level in the past and they think that it will probably hold it again. The second concept is rigidity or lack thereof. Levels should not be trusted to hold exactly to the penny, but instead should be thought of as a small range that acts kind of like a trampoline. It will bounce below it and then back up, or it'll bounce above it and then back down. The third concept is that support becomes resistance and vice versa. I'll show examples of this in the next couple slides, but once price breaks out of a resistance level, that level will often then become support and be retested later on in the future. So those are the first 3 concepts that I really want to cover today. The 4th concept we'll get into mostly in the next lesson, but the strength and support of these levels is largely a function of volume and time. And again, we will highlight that and show examples of that in the next lesson. All right, so before we end our lesson for today, I want to just show you some quick examples of concepts 2 and 3. Concept 2 was rigidity. And remember that we said levels should not be trusted to hold exactly to the penny. So here's a 15-minute chart of AMD. You can see this level here was rejected. It was later retested, but actually broke through it slightly and then failed back down. You then have a level at $119.35 that was tested here, here, and then generally it was retested multiple times kind of as a range. So if you had tried to put your stop loss like a penny below this level, you would have gotten stopped out multiple times. But if you were patient and you had trusted this again as kind of more of a trampoline or a range, you could have played the rejection of this level up to the top side again. So again, please do not trust these levels exactly to the penny. Treat them as a small range. The last example that I want to talk through today is on concept 3. This states that support becomes resistance and that once broken through, resistance can also become support. I think that this is easiest to talk through just in a quick visual example. So I've shown a 1-day chart of Meta. You can see here there's this 246.51 level that was clearly tested many times back here in June and July. And then once you broke through that level, you actually retested it, but now as support instead of resistance. And you did that multiple different times and it still held. The same exact thing happens again here. This level was tested, was tested, was tested, It was then broken through, retested, now resistance has become support, and then you moved higher. So very visual, very easy concept to understand, but an extremely important one to remember as you're trading. So that brings us to the end of our lesson on reading and interpreting price action. I hope that you got a lot out of it, and as always, I want to leave you with just a couple of quick closing comments. The first of which is that candlesticks are just one part of the equation. I know I've stated this throughout the lesson, but remember that you should never trust any one candle or any one candlestick pattern purely by itself. Please practice these techniques as much as you can by looking at charts, by doing simulator trading, and really get a feel for the concepts in this lesson, because as I stated at the beginning of the lesson, this really lays the framework and the foundation for the rest of this course. If you don't yet have a platform, but you still want to practice this stuff, I think stockcharts.com/ACP and tradingview.com are both two excellent free resources. So with that, I'll see you in the future lessons, and I hope you have a great day.